The MacIver Institute for Public Policy and the Main Street Growth and Opportunity Coalition teamed up last week to host a panel discussion on issues crippling our nation: high taxes and an overly complex tax system that puts the United States at a disadvantage compared to the rest of the world.
Frankly, taxes are a major issue, and I often refer to Wisconsin as a windsock economy, in that when the gales blow from Washington policymakers and from global markets, Wisconsin is blown in that direction. We don't really control our own destiny.
Joining MacIver and the Main Street Growth and Opportunity Coalition to sponsor the tax forum were the Metropolitan Milwaukee Association of Commerce, the Independent Business Association of Wisconsin, and Wisconsin Manufacturers and Commerce.
Low rate, broad base, and consistency. Those are the things that are actually the fundamentals of a strong tax policy, and each of them are the polar opposite of everything that emanates from Washington right now.
While the last major overhaul of the federal tax code was more than 30 years ago, recent changes have made it more complex and less fair. Recurring themes among the panel of experts were the need to lower all tax rates across the board and eliminate loopholes that allow the privileged few to avoid most tax liabilities.
If you really want broad-based tax reform, you want a low rate, you want a super broad base, and you want consistency for planning purposes.
Especially in Wisconsin, there's a lot of, they're getting the close-tail business. And again, if we look at, dropping the overall corporate rate without doing anything to the individual rate, I think we're going to get a real disconnect. I mean, Kurt mentioned to try to drop the corporate rate down from 35 down to 15, 20%, somewhere in there. But if we keep the individual rates, which are now 40 to 45%, and most of those businesses, again, are these pass-through, the individuals are going to pay a significant higher amount. You're going to see a lot of companies maybe try to restructure and go over to a corporate form. So you really need to have a balanced approach when you're doing that reform.
And the United States has fallen behind the rest of the world when it comes to a competitive tax environment. The Tax Foundation ranks the United States 32nd out of 34 industrialized countries when comparing over 40 tax policy variables. The United States beat just two countries, Italy and France.
I think this whole argument, this whole conversation is really about competitiveness, and that is the core issue at play here. So taxation, again, it was alluded to, and Kurt said it, if you want less of something, you tax it. It's a very simple, tried and true method to make sure you get less of something. So as corporations, companies, whether they're S-corps and they're major corporations, are looking at how they're going to invest their capital, taxation is one of the things they have to take into account. If taxation is excessive, they will find ways, as they must, in order to remain competitive and to remain in business, to lower that burden.
Not only the competitive advantage or disadvantage that the tax law has now with it, but it's also the complexity that you hear a lot about with, so many companies, especially the mid and small size businesses. The tax law, everybody talks about the tax law. I say we need to get it to make it less complicated and simpler, but it just seems to get, every time they do that, it gets more and more complicated.
The speakers went on to point out that if we do not reform the federal tax code now, the United States will continue to be at a huge competitive disadvantage in today's global marketplace, a disadvantage that will hamper economic growth.
But you look at the headwinds coming from Washington. 35% corporate tax rate is the highest in the industrialized world. You factor in state corporate taxes, it's 39.2%. Compare that to our major competitors around the world, industrialized nations. China is actually rather high at 25%. The United Kingdom, of all places, 20%. Canada lowered theirs a few years ago using the revenue from the oil sands to 15%, and Ireland is at 12.5%.
Canada is a great example of this. When they dropped their rates, their tax revenues as a percentage of their GDP went up. So this notion, and it gets back to these political arguments of an abstract idea of what fairness is. It just feels better to say we're taxing these guys, we're going to prove a point to them. But you're actually hurting your income in addition to lessening your chances for economic prosperity.
While the panel discussion made it perfectly clear just how challenging the current tax climate is, the experts all agreed that by bringing attention to these important issues now and demanding that both political parties lay out their plans for broad, comprehensive tax reform, there is hope that we may see real tax relief in the near future. For the MacIver Institute, I'm Jen Healy.